Namaste. In the previous session, we discussed about the financing propositions. Today, we shall be discussing about capital structure, the most important decision to be taken, called trading on equity. Now, capital structure. What do you mean by capital structure? Capital structure is nothing but composition of various long-term securities. In the capital employed of the company. So, the long-term securities consist of different components. The components are owners' funds, which are nothing but shares, which can be classified again into equity shares and preference shares. And also the reserves and surplus, what are called as plowed back profits or retained earnings. Now, on the other hand, there is also another component which is called as borrowed funds. Borrowed funds can be debentures, term loans, public deposits, mortgage loans, etc. Now, these borrowed funds carry a fixed rate of return on investment, while the owner's equity do not carry any fixed return on investment. Now, the composition of both borrowed funds and owner's equity together are called as capital structure. They can be expressed either as debt to equity ratio or the proportion of debt to the total capital employed of the company. So, debt by equity or debt by debt plus equity. Now, the process of employing more of fixed cost sources like interest or like debentures in the capital structure of the company, by which the shareholders' funds will increase, is called as trading on equity. Now, we have discussed earlier that any decision taken by a manager in his position as a finance manager should ensure maximum return on investment to the equity shareholders. Ultimately, wealth maximization. The objective of wealth maximization must be satisfied by the manager by any decision that he takes. Fine. So, in which case, if more fixed cost sources are employed in the capital structure of the company, in the years of high profits, the company will be able to provide higher return on investment to the equity shareholders. How? In the years of high profits also, the company will be declaring only fixed return on investment to the borrowed capital in the form of interest. Thereby, the company will be either plowing back more amount of profits or declaring higher return on investment. However the company does, the benefit goes to the equity shareholders. Now, we need to take into consideration the financial risk associated with that. When the company goes for more borrowed capital, the financial risk of the company increases. What do you mean by financial risk? The obligation to meet out the fixed commitments. Fixed cost. The obligation to meet fixed cost. So, when more of fixed cost sources are employed, the financial risk of the company also increases. Therefore, the company has to ensure that there are adequate profits, then the company can decide about employing more of borrowed funds. Now, by employing more of borrowed funds, the financial risk increases, no doubt at all. But an optimum capital structure will have an impact on profitability and financial risk of the company. The proportion of debt to equity in the capital structure of the company is called as leverage effect. Now, in the years of high profits, the company will be distributing only fixed rate of return on investment to the borrowed capital. Thereby, the company will be able to either plow back more amount of profit or distribute higher return on investment to the equity shareholders. Therefore, increase in shareholders' wealth due to fixed financial cost is like interest is called as trading on equity. So, this I am going to now explain with the help of two examples. Two different companies, company X and company Y. in company X, we are going to consider three situations wherein a company employs 100% equity, then a company employs 33% of debt and 67% of equity, and the third case is when the company employs 1/3 equity and 2/3 borrowed funds. Fine. And the next case, I am going to explain about an abnormal situation where the profits are not satisfactory and what happens to the company in case if it employs more of borrowed funds. Fine. Now company X and company Y. Now example 1. We are going to have a situation of total funds used is rupees 30 lakhs, rate of interest 10% per annum, tax rate is 40%. Now, in situation 1, 2 and 3. In situation 1, we are going to have equity 30 lakhs, equity 20 lakhs and third situation, equity 10 lakhs. Then debt in situation 1, nil. In situation 2, it is 10 lakhs. And situation 3, it is 20 lakhs. Fine. Profit before interest and tax is given to you as 4 lakhs. In all the situations, it is 4 lakhs. Now, in case 1, interest given to you at 10% per annum, no interest is payable because there is no borrowed capital at all. Interest payable is 1 lakh because 10 lakh is a capital employed and here interest payable is 2 lakhs. Now you get 4 lakhs as profit before tax, PBT. Profit before tax, 4 lakhs in case 1, 3 lakhs in case 2 and 2 lakhs in case 3. Now, less tax. Tax is given to you at 40%. So, 40% of 4 lakhs is 1,60,000. Here, 40% of 3 lakhs is going to be 1,20,000 and 40% of 2 lakhs is going to be 80,000. Fine. Now, you will get profit after tax is going to be 2,40,000 in situation 1, 1,80,000 in situation 2 and 1,20,000 in situation 3. Fine. Now, this is going to be your profit after tax which is available to the equity shareholders to be distributed in the form of dividends or to be plowed back in the form of retained earnings. Now, I am trying to find out EPS. What is EPS? EPS is nothing but EPS is equal to profit after tax divided by number of equity shares. Fine. So, here this is going to be 2,40,000 divided by, now the capital employed in the case 1 is 30 lakh, divided into equity shares of rupees 10 each. In the absence of any specific information, face value of share will always be 10. Fine. So that means we have 3 lakh shares here. Whereas here 1,80,000 divided by 2 lakh shares. In the third case, 1,20,000 divided by 1 lakh. Now we are trying to find out the return on investment available to the equity shareholders due to the debt component. Now in case 1, the net profit after interest and taxes 2,40,000 rupees to be divided between 3 lakh shareholders because the number of shareholders is 3 lakhs. Please remember, I told you already, in the absence of any specific information, face value is always 10 rupees. So 30 lakh means 10 rupees face value, therefore 3 lakh will be the number of equity shares, which means the equity shareholders get a return of 0.80 rupee. Fine, they get a return of 0.80, whereas by employing 10 lakh year borrowed capital, the company is able to provide 90 paise in a rupee for as return on investment to the equity shareholders. Now make a comparison. When the company has 100% equity, the company is able to provide only 80 paise, whereas 20%, 2/3 equity and 1/3 debt, the company's return on investment to the equity shareholders is increasing. Now see the big difference when the company employs 1/3 equity and 2/3 return, the 2/3 borrowed capital, the company is able to provide higher return on investment to the equity shareholders. So we are able to prove that in the years of high profits, if the company employs more of borrowed capital, the company will be able to provide higher return on investment to the equity shareholders. So by employing more of debt, the company is giving 1 rupee 20 paise per share as return on investment. I hope I am clear with that. Now let me show you one more example where the company's profits are not satisfactory. Fine. Now before going to the second example, I shall give you 3 instructions, 3 conditions which a company should satisfy before proceeding to employing more of debt in the capital structure of the company. Conditions to be satisfied by the company. Number 1, such a source must be a tax deductible source. What do you mean by that? These fixed cost sources which the company employs, namely debentures, term loan, etc. are all tax deductible source. The company will deduct tax before paying interest. And when the company makes bulk payment of tax to the income tax department, the income tax department gives concession. The benefit of that also goes to the equity shareholders. Point number 1. Point number 2. The return on investment earned by the company should be greater than the rate of return on borrowed capital, which means the company's returns should be higher. The total profits earned by the company should be higher. Only then the company will be able to provide only fixed return on investment to the borrowed capital and retain more amount of profits to the equity shareholders. But this situation is not possible if the company is earning a stable normal profit or the rate of return on investment is lower than the rate of return payable on the borrowed capital. Such a situation is a very dangerous situation. The company will not have adequate funds to meet out its fixed obligations. The financial risk of the company will increase if the company's rate of return on investment is lower than the rate of return payable to the borrowed capital. And the third one is the company must have adequate fixed assets to offer as securities. Please remember, all the borrowed capital are secured against the assets of the company. So the lender will definitely insist on a charge being created, which means the company must have adequate fixed assets to offer as security. So only if these three conditions are satisfied, the company can think of employing more fixed cost sources in the capital structure of the company. Fine? So can you go for a recap?
Fine, order முடிச்சிருக்கீங்க. Okay, இப்போ நீங்க ரீகேப் போறீங்க. புக் வச்சிட்டு ரீகேப் பண்ணுங்க.
புக் வச்சிட்டுமா?
Yeah. Yes. Fine ஓட நான் கட் பண்ணிட்டு இப்போ நம்ம we are going to go for a recap. Ready? Okay. Continue.
So let us recapitulate the topics. Fine. So to come back.
Recapitulate பண்ணிட்டீங்க. One more. Continue.
So, to just revise what we have completed, we started with what do you mean by capital structure. Capital structure is the composition of long-term securities in the capital employed of the company. The capital structure consists of two funds, namely owners' funds and borrowed funds. Owners' funds consist of shares, namely preference shares and equity shares, and reserves and surplus, and borrowed funds are considered.
Roll, recap, continue.
Borrowed funds consist of debentures, mortgage loans and term loans. Now the borrowed funds are tax deductible source, which case the company will deduct tax at source and pay the remaining amount in the form of return on investment to the borrowers. Now to the lenders, Now, sorry sir.
It's okay, no problem. Ready?
Now the second from the beginning
recap. From recap.
Yes.
Ready? கொஞ்சம் உள்ள yeah, that's
it. தடுக்குது சார் இது வேற.
Okay.
நம்ம காலம் ஏற்கனவே ரொம்ப இது இரும வர.
Okay.
Sir, very sorry.
Yeah, no, just ready? Continue.
So, let us sum up what we have learned so far. We started with what do you mean by capital structure. Capital structure is a composition of long-term securities in the capital employed of the company. Now, the capital employed of the company consists of two sources, namely owners' funds and borrowed funds. Owners' funds consist of equity shares, preference shares and reserves and surplus, while borrowed funds consist of term loans, debentures and mortgage loans. Now the borrowed funds are the funds which are borrowed from outsiders, which carry a prefixed rate of interest and they are tax deductible sources. So before paying interest to the lenders, the company will deduct tax at source and pay the remaining amount in the form of interest. Now we will express the relationship between the debt and equity as a ratio as debt equity ratio, or the composition of debt to the total capital structure of the company as debt by debt plus equity. When the company employs more of debt, the company's financial risk increases. Financial risk is nothing but the obligation on the part of the company to meet out the fixed commitments as and when they fall due. Such a problem is not there for the company which is employing more of equity, because equity shareholders cannot demand for the payment of dividend or the repayment of principal amount. But the capital structure has an impact on the profitability and the financial risk of the company. Now, the process of employing more of fixed cost sources in the capital structure of the company is called as leverage effect. What does it mean? By employing more of fixed cost sources, the company is able to provide higher return on investment to the equity shareholders. Now, we are going to discuss it. We discussed it with a table wherein we had the total funds employed by the company to be 30 lakhs. The tax rate was 40% and the prevailing interest rate was 10%, and the return on investment, that is a profit before interest and tax, given to us was 2 lakhs. We analyzed 3 situations. In situation 1, the total funds are in the form of equity only, 30 lakhs. From that, we calculated no interest because it is owner's equity. So, profit before interest and tax was 4 lakhs, nil interest. Then we deducted tax of 40%. That came to 1,60,000 rupees. So, profit after tax happened to be 2,40,000, which we divided by number of equity shares 3 lakhs. We got 80 paise per share to be earning per share in case of 100% equity. In situation 2, we discussed that a company is employing 20 lakhs equity and 10 lakh as borrowed capital, which case we got the residual profit to be 1,80,000 rupees, which we divided by 2 lakh equity shares. We got 90 paise as return. So we are able to analyze that by employing 1/3 borrowed capital, the return on investment increases. Now the situation 3, wherein we analyze that the company is employing only 10 lakh as equity and 20 lakh as borrowed capital, the company is able to provide 1 rupee 20 paise as earning per share. So we are able to understand that by employing more of fixed cost sources in the capital structure of the company is able to provide higher return on investment to the equity shareholders. So we are able to satisfy the wealth maximization concept objective to the equity shareholders. But the situation is possible only when the company is able to satisfy 3 conditions, namely, number 1, the company, whatever the borrowed capital the company has raised, that should be a tax deductible source. Number 2, the company's total return on investment must be greater than the company's return on investment payable to the borrowed capital. And we know pretty well that all borrowed capital are secured against the assets of the company. Therefore, the company must have adequate fixed assets to offer as security. In case if the company's profit situation is normal or below normal, it is dangerous to employ more of fixed cost sources, by which what happens is the company's financial risk will increase. So all these things we discussed today. We have one more example to show what happens when the company employs more of fixed cost sources in case if the company's profits are highly volatile. Fine. We will continue with the second example now. Earnings before interest and tax in situation 1, 2 and 3. Earnings before interest and tax is 2 lakh rupees. Interest in case 1. See, in the previous example we had profit of 4 lakhs, but now profit is reduced by 50%. So go back to the same example. So interest component in the first case is nil. In the second component it is 1 lakh and third component it is 2 lakhs. So going back to the same example. Now what happens? Earnings before tax remains to be 2 lakhs here. You have 1 lakh here and there is no profit available because profit is gone. The whole amount of profit earned is gone in the form of interest commitment. So the company has got nothing to retain. Fine. Now in this case what happens again? Tax rate. We had an example of tax of 40%. So here we are going to pay 80,000 rupees as tax. We are going to pay 40,000 rupees as tax and no tax. Why? There is no income at all. Only if there is an income we will pay tax. There is no tax at all. Fine. Now in this case what happens? Profit after tax is 1,20,000. It is 60,000 and no profit available. Now you calculate EPS. So 1,20,000 divided by 3 lakh. The company is able to provide 40 paise. Fine. The company is able to provide 40 paise as your this one. Now here what happens? 60,000 is the profit, fine, and you have now 2 lakh as the equity shares. The company is able to provide 30 paise, and no return is possible to the equity shareholders because there is no profit available. So in such a situation, it is advisable to employ more of equity and less of borrowed capital. I suppose I am clear with the second example also. In the second example, profit before interest and tax is only 2 lakh rupees. So the company will not be able to provide anything to the equity shareholders because every amount of profit earned by the company goes off to the interest commitment itself. Therefore, it is not advisable for the company to employ more of borrowed capital when the profits are insufficient. Yes, thank you. Namaste.